thank you for being here. So I'm one of the founders of Zartan, and we do NFT lending. So this is a Ethereum Summit. We are operating only on mainnet because the majority of good NFTs are liquidity is king, and liquidity is king at the moment in Ethereum. And so this is a bit of a business presentation showcasing what you can use NFT finance for and how are the key powers that operate the space. So I'm going to delve a bit into it, and I would say that the majority of wallets, we wish that it has more zeros, but with at least with one after the dot, so with lots of it. The majority of wallets, they don't have so many value. But from time to time, we tend to forget that we have very powerful and interesting assets in our wallet. On top of it, I don't know if you guys are NFT collectors, but this is a wallet that the user has that is filled with NFTs. And so the power of blockchain, the power of DeFi is about composability and integrating the different asset types that exist in the ecosystem. And so a user that has an NFT that is highly valued, and for example, when they were high on their value around 70, for example, if they believe that that asset is going to have value in the future, they will want to keep the asset, or they don't want to suffer some risk, but they need liquidity for any operation that they may require. And so they face a decision, or they sell the NFT that they have, or they hold, but then they don't have liquidity and they kind of don't solve their problem. So it makes perfect sense to borrow against assets. This is kind of the baseline of credit, this is the baseline of traditional finance, and this is also the baseline of DeFi. And so my talk is about NFT lending. So I'm giving you a view on what are the key points to realize when requesting loans using NFT as collectors. And so, just to give you a glimpse, the NFT market has all these players at the space. This is already an old picture. I think this is August 2022. So 1 year ago, it was already popping with innovation, popping with different players around the space. A few of them focused on marketplace, on selling, lending, pricing, derivatives, infrastructure, analytics. There is a plenitude of tools existing in the ecosystem. And NFT lending, it's a very interesting one. It's where we have Zartan, where we operate. And just to give you an idea, the cumulative borrow volume, it's already above $2 billion since I built the slides. So things move very, very quickly. And why do you need NFT lending? It's the question that you may ask. It's pretty obvious, like you can have an asset, you can leverage it, but what are the reasons that make you do this, and how the ecosystem created something that is now providing above $2 billion in loans in the ecosystem? So the first reason to ask is, what's the use case for NFT lending, and why would someone give a loan against NFT? And the reason is very clear. Like after 3AC and FTX and all these kind of problems that arise in the last years, I would say that a collateralized loan will have very big difficulties in the future. It's not going to fly. The logic of I trust you doesn't connect with you anymore because everyone seems to receive very big impact. And using collaterals that are valued above what you are providing as a loan gives a very nice incentive for a lender to give a loan, because they will know that they are protected somehow. So this is the main reason why someone wants to provide a loan on the NFT market, because they can do a risk appreciation and they can adjust the risk that they are willing to sustain by using the correct collateral level. And for the borrowing side, I have a question like, why would someone ask a loan on it? So if you have an asset that has value, you may, and this is liquid, you may want to push that asset to work for you because you want to use the liquidity somewhere else. So requesting a loan to use on another strategies of DeFi is one of the major use cases. Second use case is on geographies where selling NFTs, it's a tax event, people like to request loans because it's a way for them to optimize their tax, their tax applications. So you can have advantage on that level. There is people being super creative who can request a loan if you believe that the price of the NFT is going to be stable. You basically can short the underlying currency. Because if you believe that you are requesting a loan on it, and then you request a loan for that you are going to pay in a 90-day period, if you believe that Ethereum is going to drop in price, you will pay that cheaper. So this is a very interesting way. It's one of the only ways to short underlying currencies on the DeFi space, and it's super interesting. There is also the other players, people that try to create kind of a put option. So you will request a loan, you get the value up front, and then you know that on the due date you decide if you pay or not the loan. Then you can basically ensure that you will never have a loss higher than the amount that you have borrowed. And so these are the kind of some use cases on the space, and it's critical to look to the LTV. So the amount that someone is providing as a loan is critical. It's called a principal, and it's critical to understand the level of risk. If you have the capacity to evaluate the price of an asset today, are you able to price that asset in 90 days or 30 days or 1 year, the amount of time that you are providing the loan? It's very relevant to create here a relationship between what you are lending and the value of the asset, so that you can create like an incentive that makes sense in the ecosystem. And so there are some ways of doing NFT lending. Custodial loans is when you go to a traditional platform, you deposit the asset on their wallet and you request a loan, and they hold the asset for you. Of course, this has, you need to believe on that custodial player. You need to know that when you repay, you will get the asset back. It can be very interesting for users that have very good relationships with the custodial, or that are operating sometimes in the institutional space because they are not so used to DeFi. So there are advantages on that. Then you have smart contract lending. That is the pinpoint on using DeFi and Ethereum. So you can deposit the asset inside of an escrow, and then the escrows can have different lots of forms. Can be a vault, can be a smart contract that you can mint an NFT that holds the underlying asset, and that can also be transacted, or it can be just a smart contract that holds the NFT, and so that has a set of business rules that you know that when you pay the loan you get your asset back. Or the last case scenario, you can keep the asset on your wallet and get a loan and do a gentleman agreement with someone that's providing you the loan that you don't pay. Some people use multi-sigs to execute these. Some people are trying to build NFT lending platforms where the asset doesn't leave your wallet because people like to have it there, and then you are able to claim it. Something that's being on development, and it's very hard to achieve. These are the main possibilities here. Then it is who is going to fulfill the loan. So who is the worker that gives a loan on NFTs? And there are two types of NFT lending. You have peer-to-peer lending and peer-to-peer. These are kind of the major ones. On peer-to-peer, you have someone that requests a loan, lists an asset, and tries to get a quote, and then you have a set of lenders. Someone will give the best offer, and if they find some overlapping in between the offers, they will accept, and someone gives the loan and is fully responsible for the risk of the loan. Because of default, they will receive typically the asset as the guarantee. They hold a bit more risk, but they can customize or fine-tune the conditions because they love the asset or they want to do a specific bet on that. So it's a very interesting use case for the NFTs because they are illiquid. Then you have the peer-to-pool systems. And the peer-to-pool systems, typically different lenders pool funds. They hold these funds inside of the pool, and then you use these funds to fulfill a loan for a set of pre-accord rules between the different lenders. There's also syndicated loan that I forgot to put here, but there sometimes it's kind of a smaller pool. It's when you have 3 or 4 or 5 wallets that you get an understanding that they are going to give loan on a specific asset, they pull the funds together, and then you have a borrower that can request a loan. There are advantage and disadvantage. As I said, on the peer-to-peer system, the lender has the capability to fine-tune the conditions. They can optimize the risk that they are going to take. They can optimize the assets that they are willing to take on that loan. On the peer-to-pool system, typically it's more of a yield farming experience. You deposit funds, there is some business rules that are agreed upon, and you receive funds back. It's also typically more stable because the pool gives loans to several assets. So if for some reason one of them fail, all the others can be positive. So it's the net result of all the loans that make the difference for them. Then you have the part of paying. Paying is always a bump in the ass, but there is a need. And typically there are two types of loans in this space. Or you can do a maturity loan, that is, you decide the date where you are going to repay the loan, and on that date, the smart contract will see if you are paying the loan or not, and then you will take your asset. Or you have a margin loan, that is, you request a loan, there is a specific LTV that's always being monitored, and in case your asset price drops out of the blue, you get swiped, you get liquidated, and your asset is given to the lender. There are also advantages on each one of them. The key maturity is better for stability of the borrowers. It's also good for the lenders when they want also stability on what they are going to receive, what is exactly the dates that they are willing to take. They don't arise on perpetual loans that never get paid. So there are advantages for this type of loans. On margin loans, you have at least the lenders feel that in case of a sudden drop, they are not protected. For the borrower, typically it gives also more flexibility. You can request a loan, and you can have like that loan grinding for a long period, and you are always balancing the LTV, so you don't have to repay on a specific date. And so, depending, different use cases can have different advantage depending on the asset type. Then you have interest rates. When we talk about payment, that is, how much are you going to pay? Typically, there are three types on this space, or you get like a fixed interest rate. I say that I'm going to pay a loan on 90 days, and I decide that I agree on a specific interest rate, and I keep that interest rate. Even if I repay early, I'll just pay what was agreed upon because it was what the lender was expecting. Then you have pay as you go, that is on margin calls. You are on margin loans, you are always paying every day. You pay on X blocks, you pay a specific fee, and while you are paying the fees, while the LTVs are okay, the loan just goes on. And then you have pro rata interest, that is when you get a loan and you specify that you are going to pay in 1 year, but you need the asset for some reason. In a 90-day period, you repay the loan, you just pay the amount that you used. Typically, this is more interesting for the borrower. It also relies on more complexity on management for the lender, because they may need to recycle the capital faster, and this can be not so perfect. And so we built Sarta based on these principles. We created an NFT lending platform where we allow the users to do instant loans using tools. So we created this solution so that we could provide a wide solution for all the borrowers that come to the platform to have a good quote and something that makes sense for the assets that we hold. We also built a solution of creative pools where we can create pools with specific terms for sophisticated lenders to be able to create loans more fine-tuned on top of the general pool that we have that serves all the client base and all the asset types on a very strict guideline of rules. And then we have syndicated pools, as I was saying, like the ability to join 3, 4, 5 people, 10, whatever, so that you can fund specific opportunity that you find out. Our logic is very simple. The borrower has the assets on the wallet, they deposit the funds on the smart contract. By doing this, we help them by doing pricing and underwriting, capturing data from the market, and providing the terms as agreed on the business rules that are defined with the lender side. The lending pools receive funds from the lenders, and then the funds flow to the borrower. All of this is atomic. All of this works on on the DeFi structure. And the big advantage of our solution is that there is no liquidations for borrowers, so they are always protected. You get custom asset appraisal, so you don't, all the assets, they are not the same, they can have different results, and you also allow for the users to have pro rata interest, because it makes sense to pay for something that they are not using. We have done, and just to give you a glimpse, we have done one of the biggest loans in the ecosystem. We've done like this 128 loan against Evidenza for a 90-day period. These are the kind of things that are happening on this space. It's a very dynamic space, even with the drop on the overall crypto market and the NFT market. The top collections remain very steady, and the NFT lending activity and NFT finance is on all-time high. So people continue to bet because they believe that the best collections are having good results. On top of this, there is a rising of new use cases, new types of NFTs, Uniswap D3 positions, for example, is an NFT. These are the kind of things that people are realizing that we can jump from traditional art and PFPs on NFTs, and we can go into more mature things on this space. And it's going to be very interesting now. The next 5-10 years are going to result, because real world assets are being chained the majority as NFT because they have very specific rules. So what we have been building and what the players of this ecosystem are building is we are setting the bricks for the financial ecosystem that's arising. So it's going to be very interesting. We are one of the top segments that we fulfill is art. We are one of the main players in this space, and we perform several loans with different quotes. We performed one of the first 1-year loans on a Fidenza. That is what this would be completely unimaginable 5 years ago. So the NFT, that's a loan for 1-year period. It gives a sense of maturity to the ecosystem. People know that the assets have this kind of value and that they will hold value for 1 year. This is very interesting. We had that loan on a Squirrel for 2 years. So very interesting things are arising. We have a team of more or less 20 people work every day. A very big chunk of our team is here in Lisbon and the rest of Portugal. We are fully remote, so we have an office here. So our team that when we are around can gather. But in reality, we are all over scattered around the world. And we have been driving results. I can share on the end our June and all the KPIs that we have been achieving. We fundraised last year $4 million with Ministry of One, with Spaceship, Chile, and other players from the ecosystem and from the traditional ecosystem, and we got that along. We are releasing a new product in the next weeks about renting. And so, this is my presentation. I don't know if you guys have questions, but if you have, I'm happy to fulfill them. And thank you.
Yeah, at some point on your slide you have TAPR. So what is that? TAPR?
On basically, when you look to the APR that you are applying on this NFT space, it's very easy to look between the difference between passive APR and non-passive APR. So basically, when you have your funds that are idle for a long period, and then you get and you get interest rates for that, you need to account for that time between that. Since you are seeing like 5 calls in a row. So when you have your funds idle for a long period, and then, for example, you get an opportunity to get interest rate, you need to account for the time that you are idle with the funds, and the time that your funds are accruing interest. And so the combination of these gives you the full interest rate that you are having on that period.
So what does the T stand for?
I need to check. Can you give me? I have no idea. I'm receiving like 5 calls from a number. I don't know if this may be sorry. Hello? Yes, it is urgent. Can you call me in 30 minutes? Okay, thank you so much. No. Sorry. I thought this was not urgent. It's on. You're answering this question. Yeah. I need to. Can you show me where you saw the TPR? Oh, it's fine. Okay, I need to push it back. Give me a second. Here? No. No. I thought when I took one. Yeah. 15%. Maybe that was in our presentation. It's APR. Okay.
Because I was wondering if that's the T of the term, so was it like 50%
No,
pay for the
it's just,
day, or is it the yearly thing? Because it's a nice day that would be very expensive to.
No. 50. Sorry, this for it's for annualized rate. Okay, so the T here it was a mistake on the presentation. Sorry. Goodbye. But the part of highlight, sorry for answering that question with the highlight part, because typically these arise a lot on this space, that is when users have spot loans and they get an interest rate for a spot loan, they typically forget the amount of time that they need to fulfill a loan. And when you look as a macro, when you look back, you need to see the time in between, since you have funds and the returns that they are paying. Let's see, the T is it was a tackle.
And how do you evaluate the price of the NFT to liquidations?
So what we do is that we don't do the liquidations based on price, we do on maturity based. Okay. So on due date, if you repay the loan or not, you get liquidated if you didn't. What we do is that we do the spot appraisal when the loan is being originated. So we have an extensive analytics team and capability. We look for floor price, speed, sales, and majority of factors. We look to the collections that are liquid, that have strong data points, and every time that a user is coming to a loan, he gets a spot term with the price. And so what we do is that we price the asset, and then we apply a set of business rules, and we do underwriting. So we understand, depending on the amount of assets that are inside of the pool with a specific collection, we then identify what are the LTV that we are going to apply on top of the appraisal of the assets. NFTs at the moment, and it's very interesting, they live by themselves at the risk level. So on traditional finance, and the majority of finance, you have multiple factors of risk. The credit score of the user, the credit score of the guarantee, and all of that summed together give you the overall underwriting system. On this space, this is so new, and the majority of the risk assessment is done on the asset.
Then I think that's more like an option than on the loan, because if the price of the asset decreases too much, and I guess this should happen quite often unless you give like LTV, like I don't know, like 10% or something like that, because in the crypto space, we see 10x and we see also divide by 10 per year. So I guess, like, from my understanding of the financial product, it's still more like an option than like a loan.
Yeah, the loan, this type of maturity loans can be seen as a put option. The last case scenario, it is on the day to decide if you are going to pay based on the amount that you've requested and the price of the asset at that time. And usually, users are in reality very rational on the decision making, depending on the asset type. And that's also very interesting. When you go to high-end assets, we see trends that we don't see on low tier assets. Like on low tier assets, everything's the same. So on a due date, the users will repay if it's just a bit below the mark of what's being loaned, they probably will not repay because they are fully rational. But when you are on top traditional art, on funds, and stuff like that, Even we have seen several cases where the asset is below the principal that was provided as a loan, and the users repay the loan because they have emotional attachment to the piece, which is very interesting. But yes, in a sense, the loan can be seen as a one-off, as an option. That also applies for traditional finance, traditional loans and traditional finance. That you have two types of loans, the American standard and the European standard. They have different rules. And so,
in my understanding, in TradFi, like let's say even if you take a mortgage or something like that and your home value decreases, you still have to reverse the mortgage. You can't just say, hey bank, take my home and
that's the scenario. The part of the mortgage in traditional finance that you have legal enforcement. That users sometimes declare bankruptcy, and that the bank will do all that they can do to recover the principal and trying to have some profit whatsoever. And that happens. But what happens on traditional finance is that the fact that this is very strong legal enforcement, the users have actual incentives to either repay. But that can occur. That's the scenario if you don't have the money. And if your assets are not valued anymore, or you go bankrupt, you can go to jail. So there are other side events that can apply. But now that we are talking on that, and that's interesting. One thing that didn't, it was no product test yet on NFT lending, and talking about mortgage, the capability to do installments. So the possibility of being a law where you have a very similar structure to traditional finance. But I would say that the majority of the NFT finance space and NFT lending also inherits lots of things that come from traditional DeFi, I would say. And so a very big chunk of the frameworks that created the first products that are in the space and that are having some product market fit come from DeFi and follow those kind of rules.
No more questions?
Thank you.
Okay, thank you.
It was a pleasure. Thanks so much.
Okay, now we're going to take a pause.